let's now take a moment for a brief discussion on free cash flow. Free cash flow is a term that has become of some increasing importance in recent years, and essentially what free cash flow, that concept, attempts to capture is the idea that some cash flows are required just to maintain our ongoing activities and our current dividend payouts, but to the extent a company generates cash flows in excess of those that are required to maintain the business, there's cash available for special financing activities, which might include repurchasing shares in the company if management believes the company is undervalued. It might include acquisitions of other companies. Investment bankers sometimes are interested in free cash flow as a tool for financing leveraged buyouts of companies, where a company might be taken private with a large bank loan, but that loan would need to be repaid. So the question is, how much cash can the firm generate to repay that loan if the company were taken private in a leveraged buyout? So the elements of free cash flow essentially are: we start with the cash flow from our operating activities, which comes from the statement of cash flows, and then we back out of that the capital expenditures and dividends that shareholders expect to continue receiving. Now, in some settings, you'll see free cash flow defined as not to include dividends, but for our purpose, we'll include dividends. Free cash flow is not a term that has a single meaning, because the FASB doesn't have a requirement for what free cash flow means exactly. In our case, we will deduct preferred dividends and common dividends that are paid in estimating free cash flow, to sort of get an idea of what cash flows are available to management to engage in activities beyond the normal operating activities of the firm. As I mentioned earlier, these free cash flows are used in leveraged buyouts or other special financing activities.